So I turn to all of you, Peter. I'll just pick things up here. What's the significance of Credit Suisse? This was a known. Obviously, I mean, we're going back to before SVB's collapse when they had to pause their, I think, financials, trying to wait on approval from regulators. The issues are myriad and go back years. Why the reaction in markets today?
Well, Credit Suisse has been a slow-moving car crash, it seems like, for the last couple of years. And it's strange that what triggered it was not news or an announcement from Credit Suisse. It was just the Saudis saying, OK, we're done at 10%. We're not going to increase that. But in the context of the fragility of all these financial institutions, obviously triggered that. But at the end of the day, the Swiss government is probably going to back First, I was about to say First Boston,
right,
but Credit Suisse. But I think that we have to sort of separate the viability of these banks, European and the U.S., versus, which I don't think is in question, and I don't think depositors need to worry, but what's the profit outlook? What's the loan outlook going to be? What kind of equity raises are these banks going to have to do that's going to dilute shareholders, but at least save their banks? And what kind of duration risks are now going to get fully exposed?
There is no way you can think the economy is going to grow today as much as you thought a week ago. And Goldman, Nancy, tried to put some numbers to this, estimating, OK, if the affected banks pull back 70%, the other small banks only pull back 15% on loans, maybe you only have a quarter-point drag to GDP. It seems pretty conservative. I mean, this is starting to feel like a faster, slow-motion credit crunch.
Totally. I think what we know is that bank lending standards have already tightened. And we also know that small businesses are pressed. And so the question is going to become, what happens? Well, I run a small business. What happens? You lay off employees. And so I think long term, this gets us where we need to go. It has an impact on inflation that will be disinflationary ultimately. But in the meantime, it's going to be very important to know what you own, to know the management teams. I mean, what happened at Silicon Valley Bank was a rookie error, a basic banking 101, match your assets and your liabilities. They didn't, and they are in a sense getting a do-over for their depositors, which is good news for the depositors, and that will help keep payrolls going in Silicon Valley. But I think we thought we would see a recession this year. We've said that consistently. I think now we know that we're going to see a recession. And the question is, what is the Fed going to do about it next week?
And Peter, I'm reminded it was just a week or two ago we were sitting here and talking about how those rate hikes hadn't fully been felt by the economy yet, and they were metastasizing. And here we now see more evidence of that. So should the Fed cut with inflation at 6%? Because we can check the break-evens, for instance. It's not like you see them taking off because we're now pricing in a pause. Mm-hmm. We're not pricing in a pause and seeing the market go, oh, you know what? We're going to take the break-evens up to 3 or 4% next year. They're still probably below 2.5, 2.3. Maybe they're even down towards 2.
Yeah, the 5-year break-even, last time I checked, was about 230 today.
Here it is, yeah.
But they're not going to go from raising to immediately cutting. They should, from a risk management standpoint, they should be doing nothing next week.
Right.
Now, I know symbolically they may feel from an institutional standpoint, hey, we've been talking so tough in inflation, we got to throw one more out there. But from a risk management standpoint, they should stop. Yeah. Now, shifting to the decline in interest rates, well, that's a tougher pull for them because of this rate of inflation that, yes, will still continue to moderate. But this is different this time in the sense of the Fed's ability to address an economic and a credit or a banking challenge with let's just cut back to zero and start doing QE again.
Right.
Those tools have been taken away from them with inflation where it's at.
Andy, jump in here.
Sure. So I think what's happening today is the market's responding to the Fed's job getting done by something else. The Fed's job used to be hike rates until inflation drops to a more manageable level.
Right.
Now there's a potential banking crisis brewing that could do the Fed's job for it.
Absolutely.
And that gives the Fed cover to pause and eventually start to cut rates.
But it's odd because you're right. They're doing the job for the Fed, and yet the Fed almost doesn't want to acknowledge it.